this video, we're going to analyze about 4 companies. We're going to, I guess, more briefly go over each company as opposed to analyzing them like more in depthly. There's just so many videos or companies we need to get through, and doing one each week is not enough. So this video will be doing about, we'll do 4 of them. So that'll be Walgreens, Google, Smith & Wesson, and Wish. It's like ContextLogic, I think is the actual company. But yeah, we'll go through those kind of quickly. Maybe spend about 5 to 6 minutes on each. So anyway, let's begin. Let's first look at Walgreens. This is a company that last week I started buying because I saw pretty much some decent value. I think it's pretty undervalued. There's some things wrong with the company, and yeah, let's get into it, and then we'll talk about it. So I did this analysis on 8/11. Not too much has changed, actually. I bet the PE is a little bit higher. Dividend ratio is probably a little bit less, because I could just check quickly. Look, it's not that big of a deal, but PE 3.88, yeah, PE 18 point. Yeah, it's not like that or that different. So let's just get into it. Revenue, or some big thing. Market cap is 41 billion per D. I guess small market cap, kind of compared to other things, but they're also bringing in this much revenue, a lot of revenue. But it's look at their margins. They got 4% back here, like 4.5, 3.5, and then basically nothing in 2020. And actually, why is this? Hold on, let me try this over. I didn't put the margins. I put the net income margin these 2 quarters, Q1 and Q2, at 3% about already. So 2020 was just a weak year. Obviously, they had to close many of their stores down anyway for a majority of the year. But yeah, sorry, get back to revenue. Basically, no revenue increase. It's actually kind of decreasing the percentage, but the revenue overall is increasing, just at a decreasing rate. Their margins are really small. This is not something I like in a company. One thing I like to see is really good margins. Scroll real quick to Google, we're seeing like 20-30% margins. That's crazy. Walgreens, it's a different business. But yeah, their margins are super weak on that revenue. So equity, they went from 27.5 million shares to 20 million shares. So their dollars. Their equity in the company is decreasing. Again, that's not something I want to see. I want to see stockholder equity increase, basically. Also, that means their assets are growing faster than their liabilities. So liabilities are growing much more. Not something I'd like to see. However, the shares, they had 1 billion shares in 2017. Now they're down to 866 as of 2020. So that's about like a 15% decrease in the amount of shares. Crazy. Good to see that. The total debt, although it went up from 13 billion to 40, huge increase. Although that huge increase was 2019 to 2020. Maybe they feel like they had to do it because of COVID. It all depends. The price that I want to look at though is the price to free cash flow. When they're bringing, see, 6 billion, 8 or 7 billion, 4 billion, even in 2020, and now 2.5 billion. That free cash flow, if we put a 15 multiple on it, gives us $78 billion market cap. It's only at 41. Even if we put a 10 multiple on this, it would give us a 52 billion market cap. The stock price would still go up 25%, just based on the cash flow. And so just this number alone, again, makes everything else like doable almost, if that makes sense, because this money could go back to repaying debt, to doing really whatever, because this is ultimately the money the company's earning to invest back into their business. They're already doing 2.5 billion, so free cash flow growth, the end of this year, just giving an estimate, should be about 5 billion, which would be about about 20%, 25% increase from last year. Again, the free cash flow is kind of all over the place. They're at 6, or they went from like 6 to like 7 to like half of that almost. But if we just take an average of all this, it's about 5 billion, which is a pretty high amount, actually, yeah. And compared to the market cap of the company, it's so cheap. So I think 15 multiples the highest I would put though, because it's the revenue is not growing, which means the free cash flow probably won't grow unless it's becoming more efficient as a business. This company does not need COVID to operate. I think it makes extra money with it, but it doesn't need to. So I love the free cash flow dividend. They've also been steadily increasing too, about like 5-6% each year. They didn't really do any this year, but that makes sense. Current ratio is bad though. Debt to equity is bad. On a PE basis, the company is kind of overvalued, but when we look at the price to free cash flow, it's different. It shows that there's a lot more value. Getting decent dividend right now. Payout ratio is also not that bad, 72%. It is a little high, but it's not that bad. Not something I'd be super concerned about. So I quickly compared it to CVS and Kroger. They're kind of similar companies in a way. CVS is already kind of more established. Their free cash flow is about 9 billion on average. I took an average, and that on a 15 multiple is 137 billion market cap. Current market cap is 107. So CVS is actually kind of undervalued too. The reason why I didn't like it is CVS only has paid a 0.5 dividend per quarter since 2017, so they're not growing it at all. And one thing I like investing in companies with a little bit growing dividend, especially when it's kind of small. Kroger, a lot smaller company, 32 billion right now. They are growing really rapidly, so I'd put at least a 20 multiple on it, which would also make it undervalued compared to the cash flow. So these companies, they all are kind of undervalued according to a free cash flow basis. And again, this is like more an opinion-based thing. I guess it depends how you interpret it. They're all a decent business, but the price to free cash flow basically, or compared to the market cap, I picked WBA because of the dividend, and I just think it's much more undervalued than these companies. Much more undervalued than CVS and Kroger, based on how much money they're earning and what the current market cap actually was. Because some quick concerns: Amazon's a pretty big competitor. A lot of government regulations with these companies. Short-term financials I don't like. Current ratio is bad. Debt to equity is bad. Increasing liabilities without the increase in assets. It's got some problems, but that free cash flow, we'll see how it works. But yeah, again, not a perfect business, but I do like it. Let's go up to Google. So whoops, I did this on 8/11 too. Let's see how much Google changed. Google's at 1.84. I think that's what I did it at 1.84. Yeah, basically. So revenue growth, man, 12, 18, instead of 23%. Huge increase, 110 to 182. This and last quarter they did 117, which was already more than they did in 2017 in revenue. One thing to note, it's kind of interesting. Revenue for Google, 182 billion. Revenue for Walgreens, 139 billion. Kind of similar numbers, but Walgreens has such weaker margins, so they're not generating as much revenue. That's why Google's so much more expensive. And it's also increasing revenue. That's why that huge market cap discrepancy. But also there's a lot more hype in Google too, because the growth is a lot more easily achieved, I guess. And they're proving that. Operating margins absolutely crazy. 30% these last 2 quarters, but overall about 23%. Net income, look at, again, huge margins. 40 billion last year on a 182. The equity in the company is increasing. I wouldn't say double, but maybe 50%, 50 to 70% of what it was. Yeah, great. Shares are getting bought back, not at a rapid pace, but maybe about 10 billion each year. Yeah, that's what it kind of seems like. Except for obviously right here. The debt. They did last 2 quarters they did almost 30 billion. So if we multiply that by 2, just take a quick average. I'm not saying they're gonna do 60. I'm just saying it might be possible. 60 billion, that's gonna be a huge increase. Can we do that? I don't want to mess up these numbers, but 60 billion. I think, yeah. So let's say we put a 40 times multiple on the free cash flow. That would give us a 1.2 trillion market cap. It's at 1.84. So I quickly did this little number thing. Actually, current ratio is good. I want to say PE is a little high, EPS is really high. Too, but that's good. Market cap to free cash flow. I forget. Checked, not the other way around. Anyway, at a 25 multiple, the company should be 1,135. This is a 40, I think we did. Yeah, what is this number? Oh, yeah. I in my head, anything under 2,000 is really valuable. But this was the 40 multiple on this average. So they are increasing. I mean, here they didn't really increase, but 35%, 38%. Even this year might be like a 20, actually, maybe even a 50% increase. Yeah, 42 to 60 is about a 50% increase. So I get the free cash flow is growing and you have to put a higher multiple on it. I'm just saying the 40 is probably the upper limit of what I would put on it. Anything more than that, and I could just buy like Walgreens, who I could put a 10 multiple on their cash flow, and still it'd be 25% appreciation, assuming like over time. Yeah, that's how I look at it, as opposed to buying this at a 40 multiple with the market cap already being pretty extended. Again, I just want to say that I like Google more than Walgreens as a company. They have better numbers all around the board. The only thing that's bad is they're being priced way too expensive to what it's actually worth to me right now, and then giving it some future expectations. Even if they're growing again, it's getting ahead of itself to the point where I just don't see the value. The company's amazing, but that doesn't mean that I can pay 100 times multiple on their free cash flow, because this is ultimately going to be what comes back to the company and the shareholders. Google's in my top 3 favorite stocks, probably. I think Disney, Google, and I don't even know actually. Disney, Google, and it doesn't matter. But just because I like the company, I think it's good, doesn't mean I'm going to pay anything for it. So it's got to come down a little bit. I think below 2,000 would be spicy, but we'll see what happens. But this market cap, almost 2 billion. It's getting a little ahead of itself. But yeah, everything else this is literally a perfect business. Just the price to valuation is not there. Why did I spell price wrong here? Yeah, let's go to Smith & Wesson. Wesson, I keep saying Weston, but Smith & Wesson. So they're about a 1.17. Let me just check real quick. 1.15, is that about? It's about the same. So 2018 to now, 606, a 5%, 6% increase in revenue, then a 56% increase in revenue. I understand that from these last 2 years, a lot has happened. I guess like in the US market and kind of view of the world, I don't know if, I guess a lot to say, but I don't really want to say it. Just those hidden things, I think people, again, want guns, a lot of civil unrest, they want ammo. Smith & Wesson provides these things. That's why they had such a big jump in revenue. So their margins, 5%, 6%, oh, remember that. Operating margins, what I meant to say. 4, 7, 7, 30%. So this 4 billion increase in revenue, about 4 billion, they're able to generate so much more money because it's, I guess, above their cost, or they're able to sell more money, increase the price of their products because the supply was such in demand. This year they also had negative net income 2020. That is because I'm pretty sure that the government did limit transportation and sales of some of these goods. So that's the thing for here, and that's I think why this company did so good this year, is that like kind of almost like backlog or the want for the products, and they couldn't get it then, so now they're getting it now. I do feel like this might have, sorry to keep going, but I do feel like this might have been a peak year, and I think next year won't be as high, but it still will be higher than these years. Margins all over the place. So, but this year, here's where I get like excited though. 422 equity, 4044, 38. No, equity's going down. So, and we can see that in the debt, 187, 291, 219, 441. They basically decided, you know what, we're gonna pay back almost all of our debt this year because we made so much money, which I think is a great, healthy business decision. I do like to see that. Wait, sorry, equity's going down. I meant to say that's a bad thing. I did dive into the, like, numbers more, and they were, like, their goodwill for the company. This year, they decreased it by, like, 150 billion, or million, sorry, or 100 million. So, as maybe the years, or definitely from 2020 to 2021, this huge decrease in equity is just in like goodwill, whatever they sold. I think they sold some franchise or something. Again, this number I don't know, but I do know the goodwill number went down, which isn't like a real asset anyway. It's different than cash. It's different than like, I don't know, like a piece of property. Goodwill is just an intangible asset. So these numbers might be a little deceiving, but I actually think that's kind of healthier for the company because they're not labeling themselves as some like super what do you call it, like their assets aren't inflated because, hey, my goodwill, like just a quick example is Disney. I love the company, but their goodwill is so high because they have, again, like, so say Star Wars, Marvel, like Disney, or not Disney, obviously, like Frozen and stuff. Like how do you put money, or how do you put a price tag on those brands? And it's very hard, but their goodwill is very high, so that means their balance sheet, their debt to equity, basically all that is just might not be an accurate representation of the actual balance sheet. Anyway, I've rambled about that. Total debt decreased, free cash flow. So 43, 23, 80, the huge almost 300. So even from 2019 to 2020, 250% increase in free cash flow. Then they basically had another 250% increase in free cash flow. Crazy. I don't anticipate they'll have another 250% increase. But if we take a 15 multiple, put it on 110, get a 1.6 billion market cap, it's at 1.17, 20 billion, we get 2.1, basically 2.2 billion. I think it's somewhere in between here, because the free cash flow really could be really anything, right? It could go back to, let's say, 80, maybe 230. I think, but again, even if it goes back to, let's say 100, I think 100 would be okay, you know? It still wouldn't change this average that much. And I mean, it definitely was a cheaper company back then. I mean, I did buy it at like $16, but then I just sold it for a little trade, but kind of look dumb now. I still think, again, price to free cash flow, it is pretty cheap, but the big thing is law of regulations. That's the big thing. So that is going to heavily impact the company, and this was a pretty blowout quarter. So if analysts start saying, oh, next quarter is going to be great or blah blah blah, and they disappoint, that's going to move the price down, but it depends again how you're going to invest in it. But current ratio is good, debt to equity is great, the PE is so low. EPS is like they earned $4.55 per share when the stock was like $20, so like wild. They do have a dividend too, so even giving back to shareholders, which is pretty impressive. So I do like again, paying back almost all their debt. This is no debt company. They do have positive cash flow. It is a small company too, very little shares. This thing could fly up too. Again, that's what happened at last quarter. Just almost doubled in price because again, there's no shares to really trade the uncertainty with the next few years, I do still think, again, I've been saying this for a while, that's why I keep having Smith & Wesson on my list, because it's a small cap that sell weapons and ammo, and this type of like economic fear or uncertainty, civil unrest, these companies could go wild. That seems to be more of a trade, so I don't know if I would invest in it, but they got the numbers. Just, I don't know if it's that, or going to be that consistent. Let's go to Wish. So this is a company that someone wants me to look at. They had really bad earnings on Friday. It's down about 20%, so pre-market today is down another 3.5%. I mean, so far, but it's at a $4.7 billion company. The best way I can say what this company is, it's just another eBay. Operates a mobile e-commerce company, Europe, North America, South America, operates a platform that connects users to merchants. Again, that's eBay. So it's just a smaller eBay. The biggest question before we look at anything is, what is this company going to do that eBay hasn't already done or isn't already doing, because it's a more well-established business? And I'm not saying that this company can't compete. I'm just saying it's a tough competition. One of the reasons why I sell on eBay is because I know it's already trustworthy. I have already bought things from there. It's been around for kind of a while. It's kind of the first thing you hear about when you want to sell something online. And it's like, not like Amazon, like whatever. It's more like, I got this t-shirt, I got some old game I want to get rid of, how do I sell it? So it already has, or eBay already has that establishment, at least for my generation of people. So there's no reason for me to go to, let's say, a company like this, or like, what's the other one? I know someone who actually uses it. It's like Bacardi or something. Bacardi, I don't know. Something like that. The only way I can really see these companies competing is with the margin, saying, oh, you can get a smaller margin by coming to our platform. Like eBay, it's like 13-14% just to get rid of a product. But it's like, I'm selling on that platform because I know people are shopping there. I know there's a lot of engagement. And even though I have to pay more to get that engagement, my product sells faster. The thing with these, though, is, yeah, you have the smaller margins, but maybe not that many people using the platform anyway, in comparison. What's the other thing? I feel like there was something else important I wanted to say. Yeah, 2010 headquarters. Alright. Let's look at actually, one thing. In order for these companies to make money over time, they have to increase their margins or grow their viewer base or consumer base and sellers. eBay's already at that point where they're at like a peak level. I feel like not many people are, at least the last like 5 years, let's say. I mean, yeah, there's more people shopping and stuff, yeah, but the way they really make money is by getting those percentage increase, like a 1% increase on the selling of like a product on their platform is so much better than, like, let's say like 100,000 new users, right? Because they're directly taking that money. So that's ultimately what these companies have to do over time. But we can look at some numbers. They had $1 billion in revenue in 2017, $2.5 billion now. So about 25 or 250% increase in revenue. I mean, that's a good revenue. However, operating income, they don't make any money on it. It costs more money to get this revenue. Cost of revenue, operating income, net income. Yeah, they just don't make any money off of this. Let's go to the balance sheet. Yeah, they like balance sheet wise. 2 million assets. Equity, so they do actually have equity in the company. Equity in the company. The total debt, they actually don't have like any debt load. That'd be issued some more shares. Actually, can we go to annually? No, we don't get like any information. Issued a little bit more shares. Not too bad though. So no, I mean their balance sheet looks pretty good. And so, yep, it's good cash flow. So then, oh wow, they actually had a great 2017, 134 million in free cash flow. However, huge decrease. It seems like it's coming back. It's just not what it was. Operating cash flow is at just 0. Huh. So I'm not even too sure what to think. I mean, the balance sheet looks pretty strong. Obviously, their cash flows can be pretty weak if their income statement's kind of weak. They just don't have the money. So I mean, I would not, again, invest in this, just my personal portfolio, because I think eBay is just too big of a competitor. One thing too, I checked this out before. Go to wish.com. I can't shop on this website. Like, I can't buy stuff. I have to sign in. On eBay, you could just start shopping and then you can sign in. I have no idea as the potential of this platform, because I have to I don't feel like signing in to look at some stuff. I could just go right to eBay, you know. But yeah, I mean, maybe that's a little like jab at the company or whatever, I don't know, but I'm just saying I could go to eBay, start shopping, find the product I want, be like, oh wait, I need a account, whatever, that's fine. Go to wish.com and I have to automatically have a account. I don't want to do that commitment yet. I don't even know what's on the platform. I actually, now that I think about it, I have seen commercials of this company. I'm actually curious. Operating expense, I think let's expand all, why not? Selling and generate. Why is this like not all the way? I want to see what that says. But the operating expense that took up 2 billion. Selling, general, administrative costs, probably. Selling and marketing expense, yeah. So they're spending about $1 billion to $1.7 billion each year on advertising, which is a lot, but it's probably needed. I don't even think eBay even has that. Oh wow, it's upset. Oh yeah, and eBay had a great quarter. That's why it's down so much. So not only is the Wish doing a little bit worse over time, like multiple years, eBay is doing much better. But we're just gonna look at, just curious what was selling. Oh, eBay spends, wow, about 2.5 to 3 billion, 3.3 on, I think that's advertising, so wow. Yeah. Let's see, eBay, free cash flow, whoops, wait, oh, collapse. eBay 2.4 to 1 point, wow. So let's just say eBay earns about like 2 billion per year. Is that 2 billion? Yeah. Say 2 billion times 20, 40 billion market cap. It's a 48. Like, I'd see Wish probably has the potential, you know. But I think eBay just already has the like, what do you call it? Stabilization or like company already. Check out eBay's balance sheet. 3. Wow, equity went really far down last couple of years. Net save 6 billion in debt. Wow. Wait a minute. That's crazy. 6 billion debt, 3.5 billion in equity. They have as a tech online company, they have a 2 debt to equity ratio, 200%. That's trash. That should be so much lower. Buying back a lot of shares, wow, 1 billion to 684. Why did, I guess we go to quarterly. That's so interesting. Goodwill, they're at 4.2 billion of their total assets. That's about 8%. Yeah, about 8%. 25%. 8 times 4 is 32, yeah. 25%. No. 12.5%. Now we got it. Yeah, let's see. I guess, yeah, we don't really need to look at, whoa, look at that revenue earnings. That's like that's about a 50% profit margin. Wow. Wait, what happened here? Q2, this quarter, that's gotta be wrong. How do you make that much money on that much money of revenue? Hold on. Income statement quarterly. So they had 2.6 billion in revenue. And where is it? They had 10 billion. What happened here? And something had to happen. How is that possible? Right, that doesn't make any sense. So they had to manipulate something or sell some part of their business. Actually, I bet you the conversations have it. Earnings, it was 5 days ago. No, newest reactions. Sell all of your stock, we gotta sell it. Alright, I guess no one's commenting on that. I might just, I'll look it up right now, hold on. Okay, I'm looking at their Q2 highlights. They agreed to sell 135 million shares of the stock for over 2.4 billion. That still doesn't really account for the actually, that might account for a good portion of it, but agreed, has an agreement to sell over 8% of our Korean business. That's probably what it's from. Complete the sale of classified business to. So yeah, this is whatever they sold. Whatever this is yeah, that's it. Kind of interesting. Free cash flow. So I mean, again with this, the company, again from like a valuation point of view, if we do free cash flow, right, they can start increasing this a lot higher. Even if we assume they're going to be making like 3 billion free cash flow each year, which might not be a bad estimate. Put a 20 multiple on that, that's a $60 billion company. It's at 48, so that could appreciate about like 10%. But I don't know if I would do that. But yeah, I guess back to the original part of the video, Wish.com. I mean, I know, I guess it stinks you lost money, but I think it's important to ask yourself and everybody important questions when investing. It's, what is that company gonna do that's gonna beat eBay, especially when they've had this like really good quarter. I guess yeah, it could definitely, like, let's go back to Wish. Like, it could definitely be good over time, but I think realistically it just looks very weak financially. They do have a strong balance sheet. They could probably pull through, but I don't know if as my investing money, I don't think I could put money in this just yet. You know, yeah. So we went over Smith & Wesson, Google, Walgreens, I guess basically eBay. I think we'll wrap this video up. Let me know some comments you had below. Again, none of this is really investing advice. We're just looking at some stocks that I think have value that I might be buying. But that doesn't mean that you should be buying them. If any of these companies seem like something you like, definitely do much more research, because this is kind of only a surface level analysis. But yeah, let me know what you thought. Anyway, take care, and let me know next video what companies we should look at. I do have a lot of companies we can look at, but I would prefer to do some that you guys want to see too. So anyway,